Tighter loan limits and longer waiting periods for private property owners to purchase public flats. These are among the latest cooling measures Singapore has introduced to keep housing affordable. For more, our reporter Michelle Teo joins us in the studio.
Michelle, short and sweet, why are these moves necessary?
Well, you're really looking at ensuring housing affordability, which has become quite an issue of late. And that's because interest rates have been rising across the board, and that has a trickle-down effect on Singapore's interest rate market. Now, we prepared a little chart earlier, and you can take a look at the board here. Now, this is what we're about to show is the Singapore 3-month compounded. Yeah, there we go. So this is the 3-month compounded Singapore overnight rate average. So it started off this year at about 0.19%. Today, it is at 1.97%. So that is quite a significant rate increase. And besides this increase in rates, we're also seeing an increase in property prices. Year to date, you've seen over $260 million flats exchange hands. So those two factors, coupled with the fact that perhaps new homeowners might not really want to wait for built-to-order flats, that brings them into the HDB resale market, putting pressure on prices. And with more rate hikes on the way, this situation is just going to get a lot tighter financially.
As you said, it's going to get tighter. So who's going to be affected the most?
Well, you're looking at people who are HDB owners or upgraders or downgraders, because these cooling measures significantly, I would say, are more geared towards the public housing market rather than the private property market. And anecdotally, we've seen, for example, some condominium owners, they say, you know what, I'm going to postpone downgrading, or sellers of larger resale flats thinking about either holding off the market for a little while because they're just afraid that they might not be able to get the price that they want. Now, that's because the amount that buyers would be able to get will be lower as a result of tighter loan limits. We prepared a table earlier. Again, this is the amount that you would have been able to pay previously and the loan that you would have taken. So previously at 3.5%, you could have taken a maximum loan of 1.2 million. Now you can only take a maximum loan of 1.15 million. And the difference is you would only be able to pay, you would only be able to loan 6% less than what you previously would have been able to. Same for the purchase price. Previously, you could have done 1.6. Now you can only do 1.5. And one analyst that I spoke to earlier says that because of this tighter loan limit, she expects a knee-jerk reaction in the short term. And that sales momentum will likely slow down.
They have to cough up more cash since they can only borrow a much lesser amount from either the bank or the HDB. So because of that, the cash over valuation or COV that people are willing to pay will likely fall. So in general, in terms of prices of HDB resale flats, we can expect that the pace of price growth will slow down. And in fact, for the fourth quarter of this year, prices may even move into a negative territory.
Michelle, you talk about sales momentum slowing down. Of course, buy or rent. So what do you think will be the knock-on effect on the rental market?
Well, the rental market itself is actually already seeing quite record highs of rental prices. We are seeing 26 quarters of consecutive growth in HDB rents, 20 quarters in the private property market. And that momentum is expected to continue because you don't have the current demand is really from, say, foreigners who are working in Singapore, or even those who are waiting to buy a flat. So you have that current pool of demand, which is not being alleviated. And at the same time, you have a new pool of buyers from, say, private property owners who now have to wait 15 months before they can buy an HDB resale flat. So that really increases the pool of demand, and that would keep the prices of rental property relatively stable. But the analyst I spoke to earlier says that the impact from these private property downgraders, in a way, is likely to be relatively muted.
Let's say demand or prices of 5-room flats or executive condos, you'll notice that this segment of the market is not as big as compared to, like the 4-room flats or 3-room flats. So although some of them may be put off by the 15-month waiting period and they'll be renting, I don't think that it'll be so significant that it's going to jack up the rental price very high.
And Michelle, how will price growth as well as sales volume be affected?
Well, because this is a temporary measure, it's likely that the market will take a short-term hit. So during the last cooling measures that were introduced in December 2021, we saw an immediate impact the next quarter, that is Q1 of this year, where sales and resale prices and volume had gone down. But then it rebounded quite quickly after the next quarter. So it's a matter of whether for the rest of the year, because there are no major launches as well, that the market could really be taking a little bit of a wait-and-see approach.
We are expecting prices to maybe to move between 0 to even -2%. And for sales volume, it may drop about more than 10%. The one that most likely will have more major impact will likely be the mass market, because they are dependent on the HDB upgrader market. And these people may be affected because of they may find more difficulty selling their homes.
I'm going to push you on that point you made about a market having a short-term hit. Do you expect these measures will have a longer-term impact? And of course, define for me what that longer term might be.
Well, we really need to look at the state of play here. You're looking at not just interest rates rising, you're also looking at an impending global recession. We see already in the US a technical recession, 2 consecutive quarters of GDP decline. In the Eurozone, 80% chance of a recession. So, and these countries are our top 10 trading partners. So if there is a global economic recession that happens, it will invariably affect Singapore's economic performance. So having these measures to limit loan limits really does help to cushion the impact should financing become a trouble for some of us. And having said that, there's another aspect, which is the HDB concessionary rate scheme, which is currently at 0.1% above the CPF ordinary account levels, and that's at 2.6% till the rest of the year. But what happens after that? It's anybody's guess.
Well, thanks for explaining what's happening right now, though, Michelle Teo, speaking to us about the latest measures to cool Singapore's housing market. Moderating demand.
Moderating demand and ensuring a prudent borrowing amid rising interest rates. So that is the aim of the latest property cooling measures, which took effect today. First, the medium-term interest rate floor was raised by 0.5 percentage points for private bank loans. It is used to compute the total debt servicing ratio and the mortgage servicing ratio. These determine a borrower's ability to repay their loans. Raising the medium-term interest rate floor aims to help prevent mass defaults if interest rates spike. Next, a lower loan-to-value limit for public housing loans. It will now be 80% instead of 85%. So here's how that will work. At 80% LTV, borrowers can take a home loan of up to $400,000 for a flat that costs $500,000. The remainder can be paid using cash or the Central Provident Fund. Under the previous limit, borrowers could take out a $425,000 loan. Finally, the sellers of private properties have to wait 15 months before they can buy a resale public flat. Now, this temporary measure aims to cool demand in the resale market, but there is an exception to this rule. It will not apply for those aged 55 and older who buy a 4-room or smaller unit.
The government will continue to monitor the property market and adjust policies to ensure public housing remains affordable. National Development Minister Desmond Lee adds if there is a need, private housing supply will be increased. His comments come after a series of property cooling measures took effect today aimed at dampening demand.
This move is not expected to affect first-timer and lower-income home buyers significantly, as they may receive housing grants of up to $80,000 when buying a subsidised flat directly from HDB, or up to $160,000 when buying a resale flat. And they can tap on their CPF savings to pay for the flat purchase.
Mr. Lee says the measures are a result of rising resale prices and mortgage rates. He adds that the new rules can better protect home buyers and help them avoid potential difficulties in paying their home loans.
This new wait-out period of 15 months will seek to moderate demand for HDB resale flats and keep them affordable, especially for first-time home buyers who may have more pressing housing needs. Now, we intend for this measure to be temporary. We will review this depending on overall demand and market changes.